Hey everyone, first video of the year. Nicolas Maduro has just been captured, and this will have some important implications for the market over the next couple of weeks. So we're going to talk about why that matters and some companies that are going to do well off this news. We'll also talk about some stocks that I think are being overhyped and why I think the crowd might be wrong on those companies. Before that, let's talk about just a few different stocks that I have in mind and some short-term trades or some long-term trades that I'm seeing happening. So I want to talk about those first, and then we'll talk about the Venezuela trades. Our first chart is the monthly chart of Bitcoin. Now, rarely do we go out as far as a monthly chart, but there's an important pattern that we're seeing here. And if you've watched my videos or studied what I teach, I hope you recognize the pattern that we're seeing on this chart. And that is a wedge pattern is forming. So we have a first push, pullback, second push, pullback, and then a third push. And whenever you have a three push pattern, that's a possible reversal pattern. And we call this a wedge. So three pushes, pullback, possibly a fourth push. So either you just consider this a wedge and a double top here, or you would look at these three being the pushes. So first, second, and third. Either way, this is to me, it's clearly a wedge pattern is forming here. And what do you get after a wedge pattern? Well, you get 10 bars and 2 legs of a pullback. Normally, that's what you can try to expect. So we've had our wedge, and I would consider this the first bar of that pullback. So bar 1, 2, 3, and currently we're on this January is the bar 4. So I would expect first leg down here, pullback, and then a second leg down. So we're about three or four bars into this 10 bar 2-leg pullback. And a wedge, whenever I get a wedge, normally I would exit longs. So if I was long here and I was wanting to really trade the Bitcoin market on the monthly chart, I'd be looking to try to get out of longs below a wedge and this double top here. And so if you're doing that, where do you re-enter? Well, then you would look to see those 10 bars and 2 legs form, and that's when you would try to re-enter. So it would look something like this. We have our first leg down, then you get a pullback, and then a second leg down. So if I was to project out what the next few months would look like, I would think it might be something like this. We have a first leg, pullback, and then a second leg down. The second leg might not be this exaggerated, or it might it might fall short, or it might go even lower. But just from what I would expect, it would be something to look like this. So you'll see a lot of things online like Bitcoin stock to flow that tries to predict the price movements of Bitcoin, and that is very bullish. So that would be saying like this is absolutely the time to jump in and be a buyer. And you'll see other things online that are also pretty bullish on Bitcoin. And I don't think there's anything wrong with dollar cost averaging and buying into Bitcoin as it is now. However, looking at this monthly pattern, I do think that we will have a second leg down from this. Or at least I don't think 2026 will be as bullish of a year as people are hoping. And once again, I'm saying that because of this wedge pattern that's forming. So for me, when do I want to start buying? I would rather see the market try to get down closer to 70,000. If it can get below 70,000, then I would start to be interested in it. 60,000 as well. So somewhere in that $70,000 to $60,000 range. And that kind of coincides with this prior range that we had over in this area and with these prior highs back from 2021 and 2022. So right around this 60,000, 70,000 range, that's what I would be expecting the market to try to pull back to before rushing up and making new all-time highs and pushing higher. Now, something that might happen is there could be a failed wedge attempt. So look at an example that's actually just on this chart right here. There's a failed wedge of Bitcoin right here back in 2023. There was a first push, pullback, second push, pullback, and a third push. And this is a bearish sign. We have our wedge. We're struggling to get above the moving average, the 20-period moving average. And it looks like the market would want to try to get its 10 bars and 2 legs down. So that's why I would expect from here. But you notice this quickly runs into issues. So instead of the market following through and continuing to get bear bars, it doesn't do that. The people that are getting short here, they get trapped during this bull bar. And so when I see this bull bar, or maybe wait for the follow through bar over here, to me, that means that this wedge failed. And if I was short down here, I'd want to be getting out above this big bull bar or the follow through bar. And not only getting out of shorts, I think it'd be appropriate to buy. Buy because you have all these shorts. The people that were selling at the moving average and betting on a move down, they're wrong. So they have to get out of their longs. So they're buying back above this big bar or this follow through bar. So until we get some sort of trap or where the wedge fails, then I would not be looking to get long. I want to see this wedge play out first, or for there clearly to be a bear trap, and then I would look to get long. So 2026, I'm not selling any Bitcoin, but currently I'm not buying anymore until we get lower down around 70 or 60,000. So the next chart we're going to look at is silver. And I purposely have this zoomed back a little bit. So we're looking at September on silver. Silver had a huge year this year. Silver at one point almost tripled, but it at least ended the year more than doubling. So really big year for silver. And there's a principle, just like on Bitcoin with this silver, there's a principle that I want to get across to you. So we're going to go forward a week at a time here. And so silver had been in a bull trend for at least the last couple years. And when you get late in a trend, and then you start getting larger bars late in the trend, that will start to cause problems for different sides of the market. One problem is that people are shorting into this market. So as the bars grow larger, people will start to short. They're thinking the market's gone too far. We're starting to get far from the moving average. We need to do reversion to the mean, which usually is a mistake. And so you have people that are shorting, but if the market keeps going up, then they're suddenly caught on these short trades, and they get squeezed. There ends up being a short squeeze. So a lot of action starts to take place late in a trend. Right, the market's been moving up for several years, and now we're starting to get the largest bars of this whole trend, and they're occurring late in the trend. They're occurring up here. So you have more and more short sellers that are entering their orders, and they're getting squeezed out. So a lot of people on the short side are running into trouble. Now let's think about the longs. People that have been buying all through 2025 or even before 2024, they're buying. Now they're saying, they bought down here at the start of the year at 30, and then it goes up to 45. And they're going crazy even at just 45 because they've made so much money just from just in a few months. And then it goes higher to 50, 60. They can't believe it. They say, oh my gosh, it's gone too far, too quick. And they start to take profits. So you have the bulls, the people that have bought all year, they're now starting to take profits. And you have the people that are short, they've already been squeezed out. So the people that were short, they're already out of their positions, forced out of their positions. And it's getting to the point now where you have these, once those short sellers are squeezed, that normally is when the market has gone actually too far, right? You have to have the shorts actually lose their money. And then that's when the new shorts can come in and actually profit. So you have the longs, the people that have been long, they're starting to take profits because they've doubled or tripled their money this year. And you have the short sellers that have been squeezed out, and the market has, at some point, it officially goes too far. And that's what going too far looks like. Once you have a week that is up, 15 or 20% late in the trend like this, then you have to really wait for the mania to occur. You don't want to get caught up on saying, okay, the market's gone too far. It's getting too far from the moving average. So often you will fall into a trap like this where you just get stuck in a bad trade. What you'll find is that when a trend is occurring, it's much better to just hop in with the trend and just ride that out. If you're wanting to sell short, if you're wanting to be like Michael Burry, one of the few people that can really nail short trades and make their money from being short, one thing you have to realize is that you might be wrong for months or years on the wrong side of the trade. And so even if you're right, like even if you watched The Big Short with Michael Burry, he was wrong for many months and even a couple years. So he had to live with the stress and the pressure every day of his fund losing more and more money. Even though he was right, he had to lose money for many months to be right. And if that had lasted for a couple more months, he probably would have had to just exit his position with completely bankrupt. So it's usually just better not to try to get short. But if someone's going to do that, one rule of thumb is you have to wait for the mania to occur. So in September, you can see down here, we're in August, September, October. The market was going up pretty quickly. I wouldn't quite call it a mania yet. And then here, November, December, then you see it goes from 66 up to 83 in 1 week. So it has a year of movement in 1 week. That is getting closer to what you could call a mania. Then at that point, when people are really losing their minds, then that's when the market starts to go too far. So rules of thumb, it's safer to not short, but if you're going to be short, wait till the market goes up like 20% in a week, very late in a trend, and people are saying, oh, it's going to be, the next big move is here. And, when everyone's getting crazy about it, then that's about the time to get short. But what's better? Trying to catch that one short and waiting. Or you see a trend, a bull trend, silver's going up. So you buy silver and you wait until it's no longer going up. I can guarantee you in general, the more profitable one and the less stressful one is just finding the trend and hopping in with the trend. So yeah, when you nail that one short, you're going to look pretty cool, but you're also risking going bankrupt and you're guaranteed many stressful nights. So before we talk about Venezuela, there were still a couple stocks I wanted to just go over quickly. Here's GameStop, weekly chart. And I'm just noticing a possible short swing trade. There's a possible setup occurring here. So GameStop hasn't been doing all that well this year. Trading range, yes, we're in a trading range. However, we're starting to get a series of lower highs and lower lows. So high, lower high, lower high, lower low, and lower low. And we're starting to get stuck below the moving average. And that's something I really like to look for. You can tell through here the market would poke above the moving average and would have some runway, then it would go below. And what we're starting to see here, there's a confluence of the 20 moving average and the 200 moving average. And we can see the market try to get up twice. It tried to go up higher here and then try to go higher here and couldn't. So when you start to see the market kind of getting kind of held down by the moving average, it's kind of being controlled by the moving average. And that's an indication that market might be starting to trend in that direction. Another thing, like we said, it tried to go higher twice. That means there's a double top there. So we have a double top below the moving average, possibly in a bear trend here, lower lows, lower highs. So there's a possible swing trade setup happening here. And selling below yesterday's week, which is right here, I think that'd be okay. Or wait for the follow through bar, which we have here, and it is a bear bar. And so the idea would be to sell below this bear bar on a swing trade. So the idea would be you would only enter short if it goes below the prior week's bar. So right around 1990, you put your stop above that bar and you go for about 2 times your risk or more. Two times would be the minimum if you're trying to swing trade. So that's what a trade would look like. Shorting below there, and you're trying to get out right around 1780. And, if you deem appropriate, if you think you are early and will be the start of a bear trend, then by all means, try to go for more. Try to go for 5 times your risk or 10 times your risk. 10 times would put you right around the prior lows back in 2024. So if you try to go for 10 times your risk, you're not going to win as much, but when you do win, you're going to have a very large win. Versus if you go for 2 times your risk, you're going to win a lot more often, but when you do win, it won't be as much. So, it just depends on your personality. I think either way, either you go for 2 times your risk or 10 times your risk. At least in this situation, I think over the long term, your outcomes would be the same. So if you took this trade 100 times, I think it would be as profitable going for 2 times your risk compared to 10 times your risk. I think the expected value is going to be about the same. Next stock is a weekly chart of Costco. And I'm kind of jumping the gun on this because the setup is, I think, a few more weeks away at least. But what I'm seeing, this would basically just be a play off of the 200 moving average. 200 moving average is the yellow line. Costco's not been doing that well. I mean, it had a great 2023 and 2024, but actually since the start of 2025, it's not been doing that well. And especially in the second half of the year, it's clearly been in a downtrend. So as we get closer to the 200 moving average, I think that would be a reasonable place to try to buy Costco at. Some people that are interested in buying Costco, people that want to dollar cost average in Costco, I think the pullback would be far enough that it would be appropriate for them to start entering trades or enter a larger position at the 200 moving average. So for long-term investors, I think around 750, I think that'd be a reasonable place to buy. And then for traders that just want to take a trade and have their stop and a profit target, I think they could be able to set up some sort of position right around there as well. So I don't like to purely just play out the 200 moving average. I like there to be other things going along with it. One, I think Costco is a good stock. If it's a good company. If you go into a Costco, that parking lot's going to be full. It's going to be packed in there almost any time of the day or day of the week. It's busy. And there's something to be said about buying companies like that. McDonald's, go buy a McDonald's. I'm sure there's a line around the building any time of the day or any time of the week. That there's security, there's comfort and strength in buying a company that you can go and verify and you say, yep, it's packed. The business is doing fine. There's some safety in that when you're buying pullbacks. And that's really what this kind of trade or investment would be. You're buying a pullback in a good company. And the 200 moving average is just kind of it's an indicator that there might be some support there. And another reason to look at the 200 moving average, if the market has not touched the 200 moving average in a while, that increases the chances that there will be a bounce at that level. And in Costco's case, we're on the weekly chart, and going back 5 years, I can't see, there's not been a time in the last 5 years when the market has touched the 200 moving average. In fact, we'd have to go back to 2015 to see the last time that Costco has touched its 200 moving average. And like I was saying, I don't want to just purely play off the 200 moving average, but in the situation when it's a great company that has not touched the moving average in 10 years, that is a reasonable place, in my opinion, to try to buy on a pullback. And in general, the longer it's been since it has touched the 200 moving average, the higher probability that you'll see a bounce at that level. So for those 2 reasons, that's why I'm kind of drawn to looking at the Costco chart here. And like I said, I'm kind of running the gun because it's going to be a few more weeks before it can get down to 750. But I think it's something good to be aware of and allow yourself some time to get positioned properly in case you do want to buy at that level. All right, the last stock we're going to look at before talking about Venezuela is Amazon. Amazon is my largest stock holding, and I was a manager at Amazon for a few years. So I kind of know the warehouse side of Amazon, and I just think it's silly that Amazon has not seen better appreciation over the last few years than what it has. It's really not that much higher than what it was back in 2021. On the technical side of it, long term, yes, it's in a bull trend. That's good. We have a double bottom that occurred back in 2024 and 2025. So that double bottom's here. We see the clear touch of the moving average and then a bounce. Similarly, back in 2023, market broke above the 200 moving average, then pulled back, double bottomed, and then it raced higher. So this is kind of further support of the 200 moving average. The situation we're in now, I wouldn't say as of this week there's clearly a good technical reason to buy. In fact, there might be reason to, on the short term, to exit longs. And I say that because what we had was a double bottom at the moving average that is failing. I think it would be appropriate to have actually bought above this bar here. So we have a new high, pullback. There's a first bull bar. So this is the first entry long, pullback. Second bull bar, second entry long, above the moving average, double bottom. That looks like a good place to enter a swing trade long. So buyers there, that would have been a perfectly reasonable place to try to buy and go for a swing trade. And it would have looked something like this. Wrong one. It would have looked something like this. So you're buying above that bull bar, and you're trying to get 2 times your risk, somewhere right around here, or more. Maybe you go for basically just a swing up to 300. I think that'd be appropriate. We know Amazon's going to be higher at some point in the future, so look for reasons to buy. And I think it's okay to try to have those 10x. Try to find those 10x moves. For every so if you were to risk like $6 here, try to go for 60 and try to get up to 300. I think with a stock with a company that does well and has a long-term positive trajectory, try to get those large swing trades. So that being said, I was thinking that was a good reason to buy there, and then now it's looking like the traders are trapped. So anyone that bought there, anyone that's doing this swing trading, they've now run into trouble with last week's bear bar. So in fact, if I was long off of that bar, I would want to be exiting below the current week's bear bar. So from a day trader's perspective or a weekly trader's perspective, I'm not really seeing a strong reason to get long right here. But as an investor's perspective, I think Amazon is clearly going to be a winner over the next 5 years, 10 years, 20 years. They have their hands in everything. Like I said, as someone that's been a manager at their largest warehouse in all of Amazon, they have such a wide moat on being able to get your packages to you the fastest, and the infrastructure that they have built out, no one else can match that for a long time. And Amazon can do that in many different aspects. So, I know Google has the best AI right now, but Amazon can be competitive in AI, and they can be competitive in cloud computing. They can be competitive on the physical delivery of physical sorting and fulfillment and delivery of packages to you. So they can compete and win at so many different ways. It just doesn't make sense that the stock has not appreciated more than it has. So I have a feeling this is going to be Amazon's year. I think we might finally start to see real movement higher. Since 2023, you can see we have had some pretty nice movement up. We've actually tripled since the lows of 2023. However, that's since 2021, right? We're not all that far above the highs of 2021. So, although we have done well the last couple years, considering we're not that much better than 5 years ago, I think the stock deserves better. And so I have a feeling this will be their year, and I don't see anything wrong with buying some Amazon in January. So now to the big news with Venezuela, Maduro being captured. That happened Friday night, so the markets have not been open to really digest what has happened. So this is Sunday night, so we'll see the markets open in a few hours, and stocks will start to react, and we'll see how they open up. Typically, silver and gold see spikes when we have attacks like this, but I have a feeling like silver and gold might actually open up lower. And I say this because normally when there's an attack, that means there's a lot of uncertainty. There's this rush. No one really knows what's happening. There's the fog of war. It's scary. We need a rush to hold a real asset like gold or silver. However, in this case, the attack lasted 2 hours. Maduro was captured. It's settled. It doesn't look like Venezuela is going to try to strike back. For the most part, everything looks like it's under control. So we're not going into a new giant war here. It is. It looks contained. It looks like it's understood. It looks like there's a lot of certainty. There's not too much uncertainty now. Things actually look better now than they did on Thursday. So I'll be interested to see what gold and silver do. Instead of a spike up, I actually think there could be a small move down, or at least I'm not expecting a giant move up on the open of like gold futures Sunday night. A couple stocks I think are appropriately being hyped up. One is Chevron. As we can see here, it was the last major oil company still operating in Venezuela. So they already have their foothold there. They're clearly going to be the one that the United States seeks out to continue and expand operations in Venezuela. They also have some debt that was likely going to be quickly paid off with these new operations and the United States moving in. And I think Trump's made it pretty clear that the oil companies, the U.S. oil companies, will be paid back and really taken care of in this deal. Here's the monthly chart of oil, by the way. And a lot of people are getting very bullish on the oil companies because the United States will be making sure they have so much access to these Venezuelan fields. And I'm okay with Chevron because they already have a foothold there and they can basically just expand their operations. My trouble with getting really excited about the oil companies in general is that there's going to be a huge supply of oil coming from Venezuela now. And I think this graphic really explains this well. You know, before this was going on, most people did not know that Venezuela had the largest oil reserves in the world. They have more than Saudi Arabia, Iran. They have more than any other country. That's what it shows on our left column here. But look at the right column, crude oil exports. Venezuela has been utilizing hardly any of their oil. Historically, they did export more like in the 1960s, 1970s. So that's when Venezuela was the richest country in South America. And now they're basically the poorest. For all the reasons, they are not really exporting that much. They have not been for the last 20 years. And we can see, compared to other countries that have rich reserves, like Saudi Arabia, Venezuela is exporting hardly any of it. And I am sure that with the United States moving in, and then I'm sure the Venezuelan people are hungry to start exporting some of their reserves and start making some money. So I'm sure there's going to be a huge amount of new exports coming in over the next few years. So yes, the oil companies will have greater access to those reserves, but how profitable will they be able to be if oil gets down to $40 a barrel or less? So looking back over the last 20 years, and I'm only going back 20 years because this is really where it's relevant for us in terms of inflation, and these numbers are going to be more realistic comparisons. The times the market went below $40 was in 2008, 2016, which was kind of near the start of the first Trump term. And this is really when fracking kind of became mainstream. As I understand it, fracking really became a technology that was usable right around the 2015, 2016, 2014. And so what we're seeing here is really a huge amount of supply of this new United States fracking oil coming onto the market. The next drop was COVID. Next time went below $40 was during COVID. And that was because the world was shut down. So there wasn't that much oil demand, wasn't that much demand for oil. And, you know, the world came back online and oil quickly shot up. And all during this time, most of the governments have kind of leaned more towards a bit more of a liberal style government, kind of on the liberal conservative spectrum. And liberal being that they are more likely to tax carbon emissions. They're more likely to create restrictions on the drilling and exportation and use of oil. That has been a more taxed industry, a more restricted industry, one with a lot more red tape around it. And that has made oil more expensive because less supply. The oil companies are given more red tape by the government. The taxes are higher on it. So there's going to be less supply of it, which means prices go higher. The demand doesn't change at all, right? Everyone still drives their car to work every day. The buses still run. The trucks have to get the groceries to the grocery store. So the demand really isn't going to fluctuate that much. It's going to be more about the supply. What kind of laws are popping up or going away, or what kind of oil fields are popping up or being used up. So the changes are a lot more on the supply. The demand, unless there's some kind of shock like COVID, then generally the demand is going to be more stable. But the point I want to make here, the last 3 times it's gone below 40, it really didn't stay down there very long. Why produce the oil? Why pump the oil if you can't make a profit? So over the last so once again, this is a monthly chart. Over the last few months, since 2023, oil has been generally on a bear trend. We've been stuck below the moving average, lower lows, lower highs. So technically, just looking at the chart, you could say, well, it's a bit of a bear trend. It'll probably continue down like that for at least some time. And then just looking macroeconomically, sure looks like Venezuela is going to start producing a lot more oil. And I think that's going to outpace whatever new demand would be created from that. I also think there's kind of a trend of governments are becoming more conservative. Like I said, back in 2010, 2020, they were kind of trending more towards a liberal government, where someone that might be more inclined to tax oil. And now I think with kind of the United States leading the way, I think probably Europe and South America and Asia, they're probably leaning towards more conservative governments where they're less likely to tax oil. They're more likely to say, yeah, let's just go ahead and make our money on oil. People still have to get to work. And, let's make oil cheaper. So I think that's going to be the trend. And now we have this extra supply shock coming in with Venezuela probably going to be producing a lot of oil over the next 5-10 years. So with those factors combining, I think we're looking at 5 or 10 years of generally lower oil prices. We'll still have these shocks of supply or demand that'll happen. But I think everyone's kind of getting on board over the next few years with let's produce oil and let's get gasoline cheap. Let's be competitive in our manufacturing. Let's try to get prices down. So I think the world's kind of getting on board with that. Right. That might be a bit of a problem for oil companies because, if we're looking at oil up around 100, they're making tons of money when oil's at 100. They have their oil fields there. They're ready to do exploration because they know if they do exploration, there's going to be a lot of money for the oil that they are able to drill. When oil gets down around 50 or 40, even if we have the wells, what's the point in drilling? If it costs more to frack or to drill, why do it if we're losing money? So the oil companies probably aren't too interested in drilling below 50 or 40. But I think that's the prices that we're probably looking at. We're probably looking at getting down to 40 over the next couple of years. And, I don't know if how long it's going to stay there. But I do think the price is going to remain somewhat compressed over the next 5 to 10 years. So I guess the whole point I'm trying to make with this is I'm not that excited about oil companies if they can't make that much money from drilling oil. Yes, they have a broader base that they can work at with Venezuela being opened up, but their margin is going to be so much tighter because by Venezuela being opened up, there's going to be so much more supply, and it's going to hurt the prices on their oil in the United States or in the Middle East or wherever they're operating. They're going to make less money on the fields that they already have. So it's kind of an interesting. It'll be interesting to see how that all works out. But that's my reason for not being super excited about the oil companies, except for maybe Chevron because they kind of have a first mover advantage. They're already there. So based off what we know now that the supply is increasing, How does one increase their supply? Well, they might need a company like Halliburton. And this is kind of a brief statement on what Halliburton does. They're a global provider of products and services to the energy industry, supporting oil and gas across the entire life cycle of a reservoir. So they help locate and drill wells, and they help with the production, and they provide all kinds of other services. So I think if you want to make some kind of investment in a oil stock, I think Halliburton might make more sense because they're going to be the ones that are supplying more of the engineering to the companies instead of the oil itself. So it's kind of like there's going to be a gold rush, and maybe the people that are trying to mine for gold might not make so much, but the people that are trying to sell the shovels sure will.